The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we closed out the week of trade on Friday, we saw a bit weaker grain market. Maybe the Argentine export news having a role there. Plenty of news headlines have impacted the grain trade, I would say, this past week. And we continue to set more records in the cattle market, futures and cash. A lot of things to discuss. Joining us now for Market Perspective, Kent Beadle with Paradigm Futures is back with us here at Market Talk. Kent, it's good to catch up with you again, sir. Hope all is well.
Yeah, everything is great, Jesse. Thanks for having me on. It's a great week to talk markets because there's a lot going on.
There is a whole lot going on here, Kent. Why don't we start on the cattle side just quick, because I think that's the positive news we could say. Just continuing to set records here. I mean, with futures getting through that $200 mark this week on live cattle and cash setting some new records again. I mean, just your perspective here on this cattle market right now, Kent.
Well, so a couple of things. I think going into the week, there might have been some folks that thought a $200 tick in the cash market might be a high, that maybe that the Packers would be able to ease things back a little bit. There were more than a few steady calls or even a few steady lower calls, even though probably wasn't warranted if anyone said we were going to be lower this week. Ultimately, we had cash trade as high as $211 in the north, 201, 202 in the south, steady to $1, to $2 higher from last week. And, the reason is just very simple. It's numbers of cattle combined with consumer demand for beef that has been extraordinarily strong for all the worries that there have been about the American consumer and the number of dollars in their pocket and whether or not they were going to have to ration themselves down to lower cuts of beef or start throwing in more chicken and pork, et cetera, et cetera. It hasn't happened to the extent that would be necessary to get these cattle prices to fall back at all. And, that's not to say we haven't had corrections, because we have, but every one of these corrections to me has felt like just that, a correction, because we haven't solved the underlying supply problem. And all the economic indicators pointed at the consumer still seem to be pretty solid. So, it doesn't feel to me like we're done yet. And this week, the futures market seemed to get a pretty solid realization of that, and none so more this today on with prices trading as much as $4 higher in the Feb contract at one point in the session today.
And I think with this, there's no way we can call the top of this cattle market. And I think it just comes back to risk management by the producer here at these lofty levels, Kent.
Yeah, so risk management is kind of an interesting thing because as we've been going up, cattle had a long period where it was actually sort of leading the feeders, and we were increasing our what I call cattle crush margins, okay? And of course, the lower price corn helped that as well. We now have higher price corn, and of course, we've got nearly $280 nearby feeder cattle. And the feeders have actually been outpacing this big run in the live cattle board. And so when we look at margins, buying feeder cattle at these prices, buying corn at a much higher price than what we've had, although I'll make the argument later that corn is still cheap. The margins in cattle have shrunk up a little bit. Let's just put it that way. You may still take a look at trying to hedge these live cattle, but I'd be very much doing that with fences that give yourself some upside. So either straight puts or long puts and short calls or something along those lines that still give you a little bit of upside room against these high price feeders and the higher price corn that we currently have today.
Well, you mentioned you want to make the argument that corn's still cheap, so I'm going to lean in there. I mean, it's been a pretty decent week in the grain markets as a whole, Kent.
Yep.
We've had a great rally in corn and beans, setting back a little bit Friday, but man, I have to think it's been a profitable week for some producers. What's your view of the grain market right now?
Well, let's start with corn. Um, we're currently at today's settlement a penny over $1 a bushel off the nearby or the Dees corn lows, which were 385, and a little bit more than that off of the summer continuation lows, which I think were in the 360s. When I say corn is still cheap, it's because at $3.85 in today's average of U.S. basis across the U.S., 33 cents under, which is off about 7 cents from the peak. We're talking about 450 cash, okay, 450 to 455 cash, and after penciling in a little bit lower yield this past year, against USDA's average cost of production, which is $879 an acre, the math works out to $4.90 cash just to break even on this crop for the average American farmer. Now, no farmer is average, understand, but we still don't have break-even prices yet. And so, we've had this situation of below cost of production prices now for the better part of a year. Okay, given that situation, I would tell you the psyche of the U.S. farmer has been pretty beat up, and so they have been quite anxious to sell this rally on a scale-up basis. I think that from a percentage sales standpoint, most farmers are probably well ahead of where they were at this time a year ago. Despite the fact that prices are not all that unsimilar today as they were last winter at this time. We were in the $4.70 to $5 area through the winter until we started to get more significant break in the summertime.
Mm-hmm.
What this year of prices at inexpensive values has done, though, is it's bought us an enormous amount of demand. All right. And, we added over 400 million bushels of demand from early season estimates last year until the final crop balance sheets came out here in October. And, we continue to have a very strong pace. Saw that again today in export sales, over 1.6 million tons, 1.5 million shipments, which was a new weekly high. This week we ended up adding a little bit in our ethanol grind, and to be fair, ethanol margins are nothing to write home about, but demand for ethanol continues to grow, not just in the United States where miles driven are somewhat steady-ish, but we are importing more into Canada, and we are importing more in other places around the world, including Japan and Brazil and all sorts of places, and that's been driving up these weekly ethanol grind numbers because the sales are there on the other side, and obviously we have the bushels. We're not at a rationing price, so we can grind as much corn as we need to, and we're doing that. And of course, I say all of this because, how do you cure low prices? Well, you cure low prices, number one, by increasing demand for your crops, and the other is by, impacting supply. Now, we thought we had a bumper crop,
Mm-hmm.
and when the final numbers were put down on paper, we ended up with a crop that ended up being below U.S. trend by a fairly significant amount. Some of that, of course, had to do with the finish of the crop and the very rapid pace that this crop moved to maturity because of the hot, dry mid to August through September. But some of it, in my opinion, and this is just the way I see things, is that because of the fact that prices were below cost of production for almost all of last year, farmers made decisions. All right. They may have made decisions on how much money they were going to spend on fertilizer, on herbicide, on pesticide, on fungicide. And that ultimate yield that surprised everyone may have been a result of some of those decisions that were made. And here again, this is enough, there are two ways that low prices influence supply. One is you plant less acres, and another is you make some decisions on how much money you're going to spend producing a crop. Okay. We still have this issue going forward as we start looking ahead to 2025. And that's been a popular topic this week, people looking ahead to what the acreage mix is going to be. And you hear a lot of talk about increased corn acres because, to be fair, the math is much better than soybeans, even after the rally that we've had in soybeans. But again, USDA's average production cost, $875 an acre this year. That was their last projection. Now they'll make a new one here in May, in May. But if you take a trendline crop, we're still talking about $4.80 break even for cash, and we're staring at $4.61 on the futures board before you put a basis on top of it. This is not a profitable price for the American farmer, and it will have impacts on next year's supply as well if we can't manage to extend this rally a little bit further than what we have.
Kent Beadle with Paradigm Futures joining us here today on Market Talk. Let's bring in the soybean side of the conversation here, Kent.
Sure.
And I know the news on Thursday, Argentina slashing export taxes on many of its ag commodities. Have to think that maybe played a role in some of Friday's soy price action. What do you think about that?
It absolutely did. And if you take a look at the way the price action developed, you saw fairly quickly that the impact is most significantly felt in the soybean meal. Okay. Why is that? Well, first of all, they didn't, there was the meal and the oil where they lowered relief from the tariff levies the most. But then if you take a look at the huge amount of world demand that we continue to have for veg oils of all types, as we expand renewable fuel production, not just here in the US, but all around the world. In the end, the soybean oil market just kind of shrugged and said, this isn't actually a big deal. Where it ends up being a bigger deal is the competitiveness of soybean meal. And of course, Argentina is the largest meal exporter in the world, and this is going to make their product, essentially as of today, 7.5%, less expensive than what it was. So, it's probably going to find its way into some other locations, other export locations that it was maybe struggling to compete in. But we have heard some rumblings that the way that the whole system is going to work may not necessarily work to the benefit of Argentine exports the way that they thought that it would. And that has to do with currency fluctuations, when are currencies required to be paid, in what currency does the meal and oil have to be sold in order to be eligible for the relief on the tax levies. And I know that there's been a few rumblings on social media that this might not have as much effect as everyone thinks that it is. I think that's something that's still to be determined.
Final thoughts, Kent, as we close it out here today. Just looking across the week of the trade, and we haven't even waded into the new administration and any impacts directly or indirectly there. But obviously, a lot of news headlines impacting the markets broadly. I guess I'll throw it to you for final thoughts. What would you add for producers?
Yeah, to keep it to keep it somewhat brief, the market went into this week with some fairly negative expectations around what the president was going to do on a tariff issuance. And two major things happened. Number one, on day one, he signed 80 executive orders, and there were no executive orders on tariffs. Instead, what he did is issue some proclamations that, keep your ears open. We'll be talking more about tariffs in the future, and we may do something on February 1st. Later this week, in fact, later yesterday in his speech at Davos, he said very specifically that he would prefer not to increase tariffs on China. And, there's some backstory around that, in that President Trump and President Xi spoke the previous weekend and supposedly had a good conversation. And it may well be that the idea of reopening some of the discussion around some of those phase one agreements may be on the table. We all know that the president likes to use tariffs, not just for the sake of tariffs, but to open up a negotiating line to get things that he would like to have addressed. And so if that's what happened, and that's what's going on here, not just with China, but with Canada and Mexico as well, there may be some room to avoid some of the tariffs, which of course would be somewhat inflationary to the American consumer, but then that would avoid the retaliatory tariffs that might have some impact on U.S. exports.
Great perspective as always. If folks want to reach out to you there, Kent, at Paradigm Futures, I know they could find you guys easily online. That's a great way to start, isn't it, Kent?
Yeah. www.paradigmfutures.net. Otherwise, anyone can reach us at the phone numbers that are listed on the website as well. We'd be more than happy to hear from you if you have some questions or would be interested in getting some help with your risk management.
Always enjoy the conversation. Kent Beadle, Paradigm Futures, thank you for joining us, and we'll look forward to talking to you again real soon.
Thank you so much, Jesse. I appreciate it.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.